Financial Drew. Oh, there it is. Financial Drew.
These are the affirmative terms. So, can I start?
Sure.
Okay.
Do we have girls versus boys here?
I don't know. It just
I think we don't need to present that. Girls win.
What small veto power I have, I use now.
We don't need
My name is Nurul. Okay. So today, I'm gonna present my group on government should regulate financial derivatives.
So you're the affirmative.
Affirmative.
On the left. Over there.
Yeah.
On my left. Okay, great.
Yes.
Sure.
Okay. According to Paul Wilmert, an expert on the derivative market, the estimated notional value of the worldwide derivative market is at USD 1.2 quadrillion. To put it into perspective, typically the world annual GDP is between USD 50 trillion and 60 trillion. So on the screen here, we have the US annual GDP from 2004 until 2013. So in 2004, we have the market, US GDP, which is around 11 trillion, and then in 2030, which is around 16.7 trillion. It's important to note the size of the derivative market as it implies how vulnerable an economy is to the fluctuation of the derivative market. Hence, highlights the need for the government to regulate the market. Financial intermediaries such as insurance institutions and investment banks are important in the economies as they have roles such as supporting business operations. For today's debate, we'll argue that the government should regulate financial derivatives. Ideally, government regulation explicitly states a broad code of conduct instead of creating a complicated framework that complicates policy implementation. Essentially, this will guarantee transparency, competition, and accountability while preventing systemic risk without detecting the market behavior of the derivative market. And one of the problems with derivative market is that the current structure lacks sufficient transparency. This leads to disadvantaged investors because they make uninformed decisions regarding their investment, which ultimately led to market inefficiency. According to Partnoy and Azinger, derivative market lacks regulation that sufficiently communicates to investors the actual risk involved and lacks a real risk of punishment for bank executives who mislead investors or otherwise perpetrate fraud and abuse. Therefore, government regulation is needed to ensure transparency, which is essential to a perfectly competitive global market. An example of government regulation is the Dodd-Frank Act, which requires the over-the-counter derivatives to be cleared through clearing houses. As a result, information becomes readily available and more public. So, here are two types of over-the-counter derivatives counterparty relationships. According to the Reserve Bank of Australia, through the method of the central clearing, it can enable a counterparty default to be handled in a more orderly manner relative to a situation of bilateral exposures. In addition, according to a research done by the Federal Reserve System, central clearing of derivatives is a key financial stability objective that has been endorsed in the United States and globally by the G20. Secondly, government should regulate the derivative market to ensure equal competition between financial intermediaries, accountabilities of the financial intermediaries, and enough capital reserve for derivatives. So here, the table shows the percentage of concentration in the credit default swap market. It shows both buyers and sellers, the G14 dealers, they are the ones who dominate the market concentration. So this situation actually creates a monopoly whereby the major players in the derivative markets they are able to dictate the terms of the mortgage borrowers, such as the ability to demand a high collateral from the trading partner and lower lending rate to get cheaper funding from investors. Ultimately, this causes the market to not be allocated efficient. We also believe that government regulation is needed to ensure that banks have enough capital reserve for derivatives. This move is essential to face situations such as the liquidity issues due to unsupervised activities in the derivative market. This was faced in China, whereby the state-owned banks were at the verge of bankruptcy as they sold long-term financing products without any consideration of the default risk. The Chinese government then struck by injecting capital instantly. As mentioned in the regulation is needed to ensure that the financial intermediaries are accountable for their action. But the interconnected relationship between financial intermediaries difficult the process of identifying the source of the problem in the market. Due to such an interconnectedness, it led to the effect of systemic risk such as the collapse of the Lehman Brothers in 2008. Here is a diagram of a portion of sector of derivative market without the presence of credit rating agencies and other forms of loans such as mortgages. The initiation of pooling and trenching makes the effort to identify which institutions are as accountable to which assets difficult. Based on our research on the post-2008 crisis, we discovered that government regulation in the derivative market may not be able to fully avert the future financial crisis. Janet Yellen, in a speech given in January 2015, noted that financial systems has also grown much larger and more complex, and our efforts to understand and influence it have at best only kept at pace. This is supported by the estimation provided by Paul Wimert at the beginning of the presentation. In conclusion, we believe that the government should regulate the derivative market. This is done by providing safe guidelines to trade with it. By noting the increasing size and complexity of the derivative market, we believe that at best the government can prevent a huge financial crisis such as the one that happened in 2008.
So on our side of the debate, our main arguments involve that government should not regulate the financial derivatives market. Now, one of our key things is that, pardon me? I'm Ryan Walker. So one of our key arguments today is that transparency and regulation are not synonymous. They're two completely different entities, and that the regulation of derivatives themselves actually creates more efficiencies. And on top of that, the flow of capital and the efficient market hypothesis are part of our main arguments. Now, our three pillars that we're going to be talking about today are the leverage of capital and how financial derivatives actually cause much consumer surplus. There's a spillover effect and many ways to hedge against uncertainty. We have arguments that the OTC markets are a lot more efficient than having them regulated, having growing long-term economic growth. And the last thing is moral hazard of government, which is one of our key arguments as well, that government regulation and having deposit insurance actually creates more of an efficient market than having regulation itself. So in 1999, we had the removal of the Glass-Steagall Act, which was one of the key indicators to the 2008 crisis, as many seem to believe. Now, this kind of ensured that banks were able to take on and leverage their capital with riskier securities. Now, what we want to argue is that there needs to be kind of an elimination of the negative connotation of the term derivative, which kind of like ceased to exist post-2008. There's many arguments consisting that the 2008 crisis was entirely caused due to risky financial derivatives trading, and that we actually want to argue deposit insurance kind of creates asymmetric risk in the marketplace.
What is a derivative?
Pardon me?
What is a derivative?
A derivative is a contract. Most commonly, you might know it as a stock option. It kind of gives you the right to buy or sell another asset at a certain fixed price. Now, a buyer of a derivative, usually in most cases, will pay a premium. However, the term derivative on these financial assets comes from the fact that it's derived in the price of the asset itself, and you're not purchasing the exact asset. You have the right to buy, or in other cases, credit default swaps, you have the right to insure. So our first argument is the leveraging of capital, and just to quickly go over here, two main derivatives that we kind of bring up in our situation is that we use derivatives to hedge against uncertainty. Now, in world markets, as we are in a term of globalization where all markets are intertwined really delicately, we need that ability to be able to hedge or leverage our capital against uncertainty. If one economy were to default today, it wouldn't just default that economy, it would leave lasting ripple effects as we've seen with the euro crisis. Greece's financial troubles, the rest of the Eurozone, any kind of ripple effect spills over onto the Canadian economy, the US economy, and leveraging this capital, such as hedging, using exploiting market inefficiencies with Smith, Charles, McDonald kind of support, allows us to kind of open up free capital and kind of provide consumer surplus.
What do you mean by leveraging capital? What does that mean
In simple terms.
words? Yeah.
So when you're leveraging capital, you want to make the most of it. So when you talk about having money reserves or money sitting around in banks, I'm trying to think of an easy way to word this, however. So basically, many bankers or financial institutions are always looking to maximize return. And a lot of the situation comes down to risk versus reward. So leveraging this capital using financial derivatives and using the word leveraging is kind of maximizing that capital to its fullest potential. So when you're using derivatives and you can, instead of just purchasing assets, you have the ability to hedge, which is to bet against assets as well. So you might bet against prices going up or down. So the kind of thing is trying to create surplus with capital. I'm not sure if that kind of answers your question directly. So our next argument is that OTC markets, they're actually very, very useful in providing growth in the economy. OTCs, over-the-counter derivatives and contracts, have become very useful instruments for speculation. And now one of our arguments is kind of that instead of kind of targeting financial derivative regulation, that we want to target maybe capital reserve ratios. Instead of doing something like that, that would actually allow banks to have less money to play around with and less money to actually provide these really risky investments. But regulation between parties already exists in these legal contracts already. That's kind of the point of a stock option or derivative. In a lot of cases, like credit default swaps, it's a legal contract between two parties, or in some cases, three parties, that they agree to the terms and conditions, so they're completely liable and completely aware of what they're buying at the time. So our last kind of argument, our big pillar, is moral hazard behind government regulation. And so in 2008, a lot of the situation was kind of brought up where there was a lot of risk that, there was a lot to blame on government. And now the whole dispute comes down to, was government and bailing out, did that kind of create a moral hazard, a dilemma where these financial institutions that got bailed out or received kind of premiums or so forth from government spending, did that just give them more incentive to keep investing in extremely risky derivatives? And so firms that are constrained by government spend 4 times more than unconstrained firms. And that's kind of a big situation and a big deal that we need to look at. If we're going to be allowing... The last one?
Firms that are constrained by government spend 4 times more.
So when we mean constraint, we mean kind of backed by government. We talk about really big, large firms, large banks such as Goldman Sachs, for example. When they're so big to fail, or they're too big to fail, quote unquote, the government wants to intervene. They want to make sure that if they were to default and something bad were to happen, that they have some sort of security behind it, because there's many negative ripple effects in the economy. So in this kind of situation, we found a citation that they're actually...
What does it mean they spend 4 times more?
On financial, they leverage their capital to riskier assets 4 times more.
And they're constrained by in terms of their actions.
Yes. So just kind of in conclusion here, we talk about how maybe it shouldn't be the fact that we should be regulating financial derivatives, and this is a very large topic. However, maybe we should be looking at the transparency itself of financial derivatives, or maybe we should be actually looking to target reserve ratios instead in banks. And we look at the current situation such as China and HSBC, where China actually recently just experienced its first ever default in a private firm. And now that was a big lasting ripple effect on China as well. But HSBC, the world's largest bank, has $16 trillion in debt. And we're looking at, the government's always going to be bailing them out. So are they going to continue to go down this path, or should we be regulated?
Okay, thank you. Now, I'm going to give the affirmative side a couple minutes to rebut anything you've heard from the negative side. Something that you've heard that you disagree with.
Should I go there?
Whatever you want, it's your show. It's your lecture.
Okay, the
You're the
next,
prof.
should I start?
You can do it, you're the prof.
The NETDEL slide gives us 3 main arguments about the government should not regulate in the financial derivatives market. You can look at them one by one. The first one is about the leveraging capital in the financial derivatives market. Unfortunately, different from what they have stated, according to a survey conducted by the Federal Reserve Bank of the United States in 2010, actually nowadays more investors in derivatives market are not hedging their risk or dealing with the price risk
or the fluctuation of the price by using the derivatives. Actually, they are trying to use the effect of the leverage to maximize their profit, or even take some try to find out some arbitrage opportunities in the derivatives market, which will which the risk of the fluctuation in the price will be amplified also by the leverage effect. So, and also
I'm sorry
secondly-
for interrupting because I'm not supposed to interrupt, but can you define what leveraging capital means? I still don't really get it.
Okay, in a simple
Because
way.
everyone's using that phrase. I thought leverage meant you use $1 of yours and $3 of somebody else's to make a whole bunch of, like, house owners leverage their money. So they put 100,000 of their own money in, they borrow 900,000 from the bank, and then the value of the house goes up to 1.5 million. So they made 5 million on $1 million of 100,000 of their own. They made 500,000 on borrowed money. That's my idea of leverage. Seems like you're using it in a different context. So what does it mean to you?
My understanding in leverage is you use a small amount of money as a collateral, and you went to the bank and you borrow a large amount of money, and you use that money for investment, and you get a high return, and you give back the money back to the investment
So it's the
bank.
same as what I just said.
Exactly.
Yeah.